just before Lehman went into bankruptcy, you were in conversations with the Korean Development Bank, which I believe is a South Korean lender. What amount of money were you looking for them to contribute to Lehman?
Congressman, our conversations with KDB as one of 5 banks in a consortium stretched over a number of months.
And can you tell me the amount that you were looking from the consortium?
It wasn't so much that we were looking from them. Their original proposal was they wanted to buy in the open market close to 50% of our stock. It was not about giving us new capital. They wanted to buy close to 50%.
And was that type of arrangement something that you were looking for at that time?
I would have welcomed that transaction, yes, sir.
Okay. Now, at about that time and looking for that kind of a transaction, you knew, because you had known for some time, that you were already in a precarious situation. And I say that because there were reports that as far back as Christmas of 2006, that you were telling people that you had a cautious outlook for the year ahead. The next month in January, when you were at Davos at the World Economic Forum, you were reportedly telling people that you were really worried about the risk inherent in the property valuations and excess leverage and the rise in oil and commodity prices. Is that fair to say that you were of that mind around January of 2007?
I was clearly focused on oil, yes, sir.
Then I think we go back to the situation, knowing that you were in that stage of mind. In December of 2007, at the end of that year, there were payments made out, both cash and stock bonuses to your employees. And they total about $4.9 billion. So is there any thought given at that point in time to say to your employees, this isn't the time to be handing out $4.9 billion in cash. We've got a liquidity issue here. We've been seeing it coming for all year long, and we're going to keep that money in the company liquidity for the benefit of our shareholders, for the benefit of the public with whom we deal, and for the economy.
At the end of 2007, I did not believe at the time that we had a liquidity problem, and our most important assets in the firm are clearly our employees. They are the ones that touch the clients every day and do business every day.
I understand. I'm a little shocked. I mean, a lot of other people thought that you had a very precarious position. At the end of 2007, you thought everything was fine?
We had just completed a record year, sir.
And you, well, I can, if you want to, I just want to cover that for a second. The record year that you just completed, and the reports on that had some, according to one account, had some rather aggressive and bizarre accounting practices on that. They list out 4 or 5 things that they thought were strange. You listed a $722 million paper profit on level 3 equity holdings. The stock that doesn't trade publicly, there aren't liquid markets out there. You claimed a 9% profit on them. At the same time, Standard & Poor's index on publicly traded stocks fell by 10%. That was what made you seem they had a record year. One of your short sellers, Mr. David Einhorn, said that he was told by your chief financial officer that $400 to $600 million came from writing up the value of electric generating plants in India. He thought the value around $65 million, not $400 to $600 million. He also said Lehman showed some $600 million of profit because of the decline in the market value of your own debt obligations. And sort of assimilate that to the fact of permissible accounting, surely enough, but it's like the profit that you make when your house is foreclosed for a value that's lower than your mortgage. And lastly, he said another $176 million was on your books by almost doubling to some $365 million, the value ascribed to certain mortgage servicing rights. In other words, the value you get paid for service mortgage holders, collection of the paperwork, which are sort of tricky things to value. So I know that at the end of the year, maybe your books look like they were good, but if those are the reasons for that, then I think it's questionable why $4.9 billion is going out to the employees in bonuses, cash and stock, then why you're spending another $4 billion buying some of that back. And I think one of your investors here today clearly said he was horrified to find out that you were doing that, and that's why I raised the question. Thank you, Mr. Chairman.
I would just note, Mr. Fuld, that in January of 2008, there was a presentation to your board on which you served by Eric Felter, and he said very few of the top financial insurers have been able to escape damage from the subprime fallout, and a small number of investors accounting for a large portion of demand liquidity can disappear quite fast.